Welcome back, guys. In this video, we're going to review the process to get a mortgage and also review the different types of mortgages that exist out there to buy a home. So without further ado, let's look at the different types. So there's mainly three types of mortgages that you can get. One is the conventional. This is typically what you would go get at your local bank. The first two are the ones you typically go get at the local bank, your credit unions, and so on. The difference between a conventional and non-conventional is non-conventional is backed by the government. It's a Fannie Mae and Freddie Mac conforming loans. Those are typically FHA, VA loans. Those we considered non-conventional. So what are the differences between the two? And of course, the third one is the hard money or private money loans. So for a conventional, if you look at the different characteristics, the interest rate is the lowest for a conventional loan. Right now, as I record this video, the national average is about 6.46%. And that's tends to be the lowest out of the three options. The minimum down payment also tends to be the lowest. It's 3% is the minimum, but typically they expect you to have at least 20% down for these type of loan to get the best rate and also the best terms. Minimum credit score tends to be the highest required out of the three types. It's 620. And the maximum debt to income ratio, which is the DTI, is 43%. And that's the lowest out of the three options again. And you tend to have a higher loan amount maximum, which is $726,200 for a standard loan. For a jumbo loan, it's anything above $726,200. If you're putting less than 20% down, you are required to have private mortgage insurance, which typically is around 2% of your loan amount. The closing cost is about 1 to 2% for a conventional loan. And that tends to be, the term tends to be 10 to 30 years, 10, 15, 20, 25, depending on what you decide to do. And you have the option of doing a fixed or an adjustable rate and an ARM rate, which is typically fixed for a certain amount, anywhere from 2 to 5 years fixed, and then it starts adjusting after that. So the plan being you refinance right after the fixed rate term period ends. And then you finally have an interest only. If you decide to go with the interest only, you have that option as well. Some banks still offer that option for a conventional. For non-conventional, the interest rate is slightly higher. The minimum down payment is slightly higher, but still at 3.5%. There's less restrictions for your credit. It's 580 instead of 620. The maximum debt to income ratio is 50% instead of 43%. And the loan amount is much lower at $472,030. And then there is a private mortgage insurance requirement, which is similar to the conventional loan. Closing costs is around 2%. And the terms offered are 15 and 30 years. And they do offer fixed and adjustable rate. But again, FHA tends to have less restrictions, and then it's easier to get than a conventional. And then finally, the hard money. Hard money is for private. This is for investors only. If you're trying to purchase a property that you're trying to fix and flip, then you would tend to go to hard money. They have the least amount of restrictions in terms of personal credit, and I think some private lenders will go as low as 500 credit score. As far as the max ARV LTV, ARV is the after repairs value, and LTV is loan to value. This is 70% is the maximum that they would go. Typically, hard money loans are focused on the property instead of the borrower. They qualify the property more than the borrower. The interest rates are very high, 19 to as much as 19%, 9 to 19%, as much as 20% sometimes. And the term is only 6 months. So and the closing cost is much higher, almost double at 3 to 5%. The plan being you coming in, buying this property, fixing it, and flipping it within that 6 month period. So this is again for investors only. They're focused on the property, the deal itself, and it has to make sense. So after you buy it and spend money to fix it, that amount has to be less than 70% of what the value of the property is after you have fixed it up and ready to resell it. So once you identify which loan and type of mortgage you're going after, then you'll have to follow these steps. These are typically the steps that you would go through for a mortgage. The first one being you submit an application and you get pre-qualified by your lender, whether that's your bank or a mortgage broker. And then once you have qualified and you have identified a property, you submit your documentation. This includes your W-2, your bank statements, and any associated documentation that is required for the loan. You submit an executed sales contract to your bank and the title company so that they can open title. And then once that is submitted, they order the appraisal. And then also, in order for the sales contract to be executed fully, you have to submit your earnest money to the title company, and that will officially get the process started. The lender will order an appraisal, and you would have to pay for that out of pocket. Once you have ordered the appraisal and the appraisal is completed, the lender will complete the verifications of your employment, verification of rent, and the different types of VOR, the VOEs, and the VOM if this is a refinance. And then finally, the lender will provide you a clear to close, or they will come back and say, we need one more item one more condition or two more conditions in order for us to close this loan. And then once that is completed, you are ready to go to closing. And this is basically the process from a mortgage perspective, guys. Once you've submitted all your paperwork, you've identified the property, went through this process, then you're ready to close the deal. Next video, I'll talk more about what to do as a real estate wholesaler, what that entails, what different types of tools that you can use, and we'll go in depth around that. Till next time, guys, subscribe and like. Thanks.